Hey, this is Sasha. Thanks for joining me here for another episode on Hungry for Returns, where I answer your trading and investing questions. If you have a trading and investing question, feel free to reach out by submitting one by voice on our website. This week, we're talking about option assignment. So I'll give you my thoughts and insights about option assignment, as well as somebody who got into a little bit difficult situation with option assignment, because it does happen. So stay tuned, take a listen, and let's kind of go through it, break it down. And based on my own personal experience, what can happen with these things and how can you reduce the effects of assignment?
Hello, Sasha. This is Greg. My question has to do with what to do when you are assigned the stock when placing a calendar trade. So a couple weeks back, Beyond Meat stock price was around 152. I ended up finding some 135 calls for 24 cents. It was sell the 927s, buy the 1018s. This was a 37-day trade. Within a week, I was assigned the stock, and I didn't know what to do. My account had this $100 and something thousand position, so I called TD Ameritrade, asked them what to do. Long story short, they told me to exercise my option, my October option, and it'll cancel out the 1,000 shares I'm short. So I just want to know, is there something that could have been done better as far as maybe either making profit out of this, lessening my loss? Thank you. Look forward to hearing the answer.
Okay, so I took a lot of notes there. Sorry about stepping aside. So this is actually my second or third time listening to the video or call, because sometimes when you're doing this, it's difficult to, I guess, discern what's happening on the audio than what the real position is. Plus, I'm also recording these usually a week or two later. What you need to understand is I'm going to give you my insight as far as based on the information that was given. Of course, the situation might be completely different. So I'll just give you kind of some general ideas as well and things to think about. So that goes for other people who are listening to this video as far as assignment goes. I don't know your personal situation. I don't know what happened during your assignment. So this is why you have a broker you can call and ask them questions. And it's also one of the reasons why you also have that extra buying protection that you do when it comes to trading options. Anyway, so let's go on paper here, and I'll share with you some thoughts and insights and give you my own personal taste on the matter and situation. So we take a look at, here we have Beyond Meat. I took some notes. Here is the 152 was the stock price. So this was the price it was trading. And you sold the 135 calls. And if the stock price is 152 and you sell a 135 call, this is already in the money. And that's a problem. This is where you typically get assigned, is when you're trading things in the money. And it's weird that you got assigned 7 days later, because normally the assignment stuff happens like the last week and so on. But you got assigned 7 days later, and it's probably because you were trading in the money. So this is my assumption. From the looks of what the prices were given, 152, and you sold the 135, it seems as if you sold things already in the money and you bought the 1018s for protection. Now, these 1018s, 135 calls, from my notes, what it seems like, you paid, or the cost of the trade was about 24 cents. Okay, so this was a debit because it's a calendar trade. So the question is, well, what do you do in these kinds of situations? So I'll give you kind of two main tips. Number one tip is, or point is, anytime you're short, you can get assigned. And more importantly, anytime you're short in the money, especially, this is when you get assigned, because this is the legal basis. So anytime you're short in the money, you're going to get assigned. So how do people avoid these things? Option traders, a lot of people like myself, I like to just trade kind of a couple things. SPX and RUT. And SPX and RUT, it's cash settled. There is no assignment. If you want to trade and avoid earnings, You can still get assigned with these, but let's say like EEM, DIA, IWM, but these are no earnings. So you're always looking to how do you reduce risks, right? Because you were talking about less loss, risk reduction, or more profit. Well, your broker, at that point, once you're assigned, you're already assigned, right? So what they typically will do then is, yeah, well, this is why you had these calls. It's for that reason, to protect yourself. That's kind of the bottom line. And normally people that go, like let's say 37 days out, they may hold it for 2 weeks or about half the duration, let's say 20 days here, since that's almost 40 days, and then you get out of the position. In your case, you held it for 7 and you had assignment. So my guess, again, this is my guess, is this was started out in the money and it continued to go against you. And with such a low debit at 24 cents, you got assigned. So the other thing is kind of not start things in the money. So when I look at these trades, before we do, remember that assignment, anytime you get assigned, there's more commissions, right? Now, normally it's not a big deal, even if you do get assigned. Okay, if you don't have the money, it is a big deal. But if you do have the money, okay, you get assigned, so you bought the stock or you got the stock, and then the next day you sell the stock. Okay, it's liquidated. Sometimes the broker forces you to do this, or they give you a margin call, like a couple days to do it in order to make it happen. So anyways, let's look at this position. I kind of played with a couple things. Again, this is a couple weeks later, so definitely prices are way different at this point. But what I want you to understand is that, hey, if I'm trading anything in here and I'm short, this is already in the money, right? If I'm short here, I'm in the money. And the reason I think and believe this was started at or in the money, because it's 24 cents. And the way I get to 24 cents is, look, if I'm selling, because right now stock price is 155, before it was 152. So the 135s were sold about 37 days out. So let's see if we can find about 35 days out. Let's see if we can do the 135s, see what that looks like. Sell a single. Okay, so here is our trade. You can see I've played with a couple of these here. So we sell a single right there. Okay, so that means that, hey, I'm already kind of in the money, right? I'm selling this one. I need it to go the other way, right? Because I could have went with a put right here. Well, we'll talk about that in a second here. So here I'm setting up to protect myself because of this continued downside. So what do? Well, we went 10.18. So the next one was about, let's say this November, and we're going to go 135s here, buy a single. Okay, analyze the trade. So what kind of trade does this give me? Well, if you kind of look at it, it's kind of a funky little trade. Here I got the 135, sell one, buy one, and let's just make sure I got everything reset, volatility. I'm basically looking at, let's see, why does this look so funky? Let's buy a calendar, because we're probably, here's the 35s. Buy a calendar, and we got the calendar on selling the October 25th, buying the November 19th, and yeah, it's basically only 5 cents right now. That's kind of the issue. Okay, there we go. So it's very similar trade. You had 24 cents. So I'm going to try to bump this up to, let's say, 140. And even then, the price is not perfect. Let's say 145. Okay, so negative 55 calls or so. I mean, I can't get the perfect pricing here, but you see what's happening here is, okay, I'm risking like $10, $20, and I'm in the money to potentially make like $200. And this would work out great, but hey, if this stock price, let's say, continued to move this way, well, I'm deeper and deeper and deeper and deeper in the money. Now, again, this is just an assumption, but I'm short, right? I'm short right here, and I'm in the money. Now, I could go ahead and let's say we do 150s, because right now stock price is about 155. All of a sudden, this has a little bit of a different picture, and you can see, hey, it doesn't look as funky. And that's what happens when you're trading kind of things in the money. You get that problem or issue that occurs. So now I'm at 50 cents. So maybe it was around here. Let's say 149 is not traded, 145. See, it still looks funky. So about 150, let's call it 50 cents here, right? So what happens is, okay, you believe it's gonna go down, but stock price keeps going up. So this becomes just deeper and deeper in the money. The better approach, let's say I would have done a put. Now a put, you can see, cost me a lot more money. Okay, this cost me about $1,000 to put on. Whereas if I would have done a call, okay, you can see, hey, I'm putting on a trade. It cost me about $32 to make 180, but I'm not in the money here. So 1,000, okay, and now I could make about 500 bucks, right? But I'm not in the money. So again, there's trade-offs. So this is the thing you have to be aware of, is that number one, are you starting things in the money? If you are and it continues to go against you, then yeah, of course, you're already in the money. Now, in some situations, this could be interesting where, and I'll show you an interesting situation where this could be beneficial, where you go ahead and it's kind of like a collar, not a collar, back ratio spread. And let's see if we even have it here, back ratio spread, where you do one of these in the money to offset the risk, right? Because now I got 170, 165, so I flattened my risk curve, but I have this dip, and then I have an unlimited risk. So in some situations here, I have a 165 right there, but the current price is 155, all right? So if I look at it here, 165, and the current price is 155. So far, so good. And what you can do is these, when you're short one, and this goes kind of in your favor because you actually want it to go up, well, you're offsetting the risk by selling one. And if it goes to 170, which you kind of want it to explode to 200, well, your 165 actually then becomes in the money. But your other ones, because you got two of them, offset that risk and problem. So in that case, it sounds interesting with a back ratio. But nevertheless, I mean, even then, being in the money, this is what a lot of traders don't like, is when you're in the money, hey, you can get a sign. So again, you can trade, going back to our diagram, what you can do is trade the SPX or the RUT. Number two, stay out of the money. If you're starting it in the money, don't start it in the money. Number three is typically you're not getting a sign until like the last week of expiration. If you got that quick of an assignment, then something was either weird, wacky, it moved against you, you know, and within 7 days, you know, your premium just falls off, because people who ultimately have these contracts and they're worth something, like let's say, hey, you went ahead and bought some insurance, well, you might as well keep it kind of towards the end and then use it the last couple of days if that's what you need to do. Otherwise, if it's not worth anything, then it just expires because I bought the insurance. But if my insurance is worth something, well, do I have to use it right when it kicks in? No, people will hold on to it because they're insured. That's why they're buying it. So I might as well hold on to it because I'm insured, and then they'll use it, you know, like a week before the expiration. So that's kind of a few things that you might want to think about. Also, usually, like let's say you're trading 40 days out, well, you might hold the contract for 20 days. In this case, this was only able to be held for, you know, 7 days. So again, which kind of makes me wonder, you know, how deep in the money were you? So if you do get assigned, and once you get that assignment, yes, you have that assignment risk and problem anytime you're short. But if you get assigned, well, this is why you have that other one for protection. And typically you just, yeah, go ahead and you turn around and use that to compensate for it. A lot of times the broker will give you a margin call if you don't have enough money to get the funds there or to sell the contract. So even if you were, let's say, negative, I don't know, let's say $2,502, and then you go ahead and sell the stock, well, all of a sudden you sell the stock for $101,209. Well, your risk and your chance of difference, right? Because it depends where the stock opens and closes, of course, all those factors play into consideration. But yeah, they may seem like big numbers because now all of a sudden you went from trading tiny options to big time money. Well, yeah, okay, well, you know, it's an $800 difference. Really, the big picture is kind of like, okay, 5, 6, 7. You know, it's not huge. Might be a little less, a little more. But the point being is that difference usually is not as big of a deal unless you get like a major movement in the price. Of course, you might not have the money, and that's where people freak out. But that's why, okay, they give you a couple days, you sell it, liquidate it, and you're kind of done. So anyways, those are kind of my thoughts and tidbits. Number one, you know, don't trade in the money or start things off in the money. Number two, trade things that have a little longer duration. If you're trading like 5 days duration, you can get a sign pretty quickly. If you have low premium, like let's say you're trading the call side and it's like, hey, tiny amount of premium, yeah, those things have a higher chance of being assigned because, well, people probably want to use up. They're way in the money, they're going to use it up. And if you really want to avoid it, well, you could just trade the SPX or the RUT and then not deal with it at all. So those are kind of my thoughts. I hope this makes a little bit of sense. Again, every person's situation is different. Your stock situation might be different. Your trading might be different. The way and style you trade might be different. I might have not understood the notes or the way things were phrased because I'm not looking at the screen or the trading account. And this is why we do coaching calls. So if you're interested in a coaching call, you know, you can always reach out. We can go over some things in more detail for anyone that's interested. But that allows me to kind of look at things and explain things in multiple ways. But ultimately, you know, remember, anytime you're short, you can get a sign. Doesn't matter. It's a calendar, butterfly. Anytime you have a -1, you're short, and especially you're in the money, that's increases your chances, really. You're short, you're in the money, your contract can be fulfilled. So comes down to in the money. Are you in the money? And with TD Ameritrade, they'll put like a little yellow icon. It's called like ITM, in the money. Buy your stock if you're in the money. Anyways, let's wrap this video up. I hope you found it helpful, insightful. Your situation might be a little bit different, so be aware of that. Thank you so much for joining me. If you have a question, go ahead and check out the website. You can submit one by voice. If you want to schedule a coaching session, check out the website or just subscribe to YouTube, clicking the face icon here. Thanks again, and I'll see you next time.